Now, basically, what happens is that some companies may have more than one business, and one business may be core, the other one may be not the core business of the company, or one may be too large, the other one might be too small, or more so, it might just be that they want to enhance the smaller business and therefore they want to enter into a joint venture. In all these cases, what happens is that a company is a legal entity, and to focus on individual business for the purpose of getting partnerships or getting rid of unwanted business, the companies get together to the resort of demerger. And this concept is very, very prevalent in the Indian context. So what happens in case of a demerger is, let's say there's a company X Limited, which has two businesses, A and B. Now, they want to induct a strategic partner in the business A. For this, what they can do is they can transfer the business B to another company which may be interested in buying it, or this company may actually be a part and parcel of this particular group. The question that happens is, what happens in such a case? What is the meaning of demerger? Demerger is nothing but the splitting of a company into two parts, whereby the shareholders who are owning the legal entity also become shareholder in the company to which the business is transferred. So when we look at this particular case, what is going to happen is, for a shareholder perspective, earlier he was having shares only in X, but now he has shares in X and Y. The question is, does he pay capital gains tax on this? And if so, how much? And if not, what happens to the cost of acquisition of shares of X and Y? Because for Y, he hasn't made any payment, but he's given some of part of his right in the assets which were there in X Limited. The second question which comes up is, insofar as this legal entity is concerned, if there are some losses which pertain to business B, which is getting transferred, will those losses be transferred to Y Limited or not? And the answer is yes. The reason being that, in many cases, the tax law provided, but subject to certain conditions. Insofar as the shareholders are concerned, if the demerger meets the condition or the definition under the Income Tax Act, splitting of shares into shares of two companies is again not taxable in their hands. Now, what happens to Y? It is getting certain assets. In exchange, it is issuing its shares to the shareholders of the transferor company. So from Y Limited's perspective, the accounting for these assets, whether it is going to be based on tax, is it going to be on the accounting value, that becomes important. And second, the issue of shares in this company to the shareholders may actually result in change of ownership by more than 51%, in which case the tax losses of Y may also lapse. So it's very important when you're undertaking a demerger exercise that all these aspects, the taxation of shareholders, the cost of acquisition of the new shares and the old shares, is evaluated. The transfer of tax losses relating to the business transferred from both the transferor and the transferee perspective is evaluated, and what is going to be the implications in the hands of the new company are also evaluated. If you need help with any of these aspects in terms of structuring your demerger, we'll be happy to help. You can contact us through various modes which are mentioned in this slide, or by leaving your name in the description comment below.